How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to be taking a look at a two-part series from PCBB, a couple of blog posts from them, looking at how non-bank lenders have really encroached upon banks' space in commercial real estate lending. So we're going to look at the first part is basically detailing, what are non-bank lenders doing? What are they doing well? What are they doing not so well? And then the second part is going to look at how to basically banks can, what advantages do banks have and how can banks leverage those advantages to basically keep their customers happy and keep lending to their customers as they continue to get more competition from these non-bank lenders. So let's bring this in. So this is titled Commercial Real Estate Lending Part 1, Non-Banks Fill Gaps, Not Expectations. So the summary reads, private lenders are filling the CRE financing gap thanks to looser underwriting, more reliability in rates, and growing investor confidence. We discuss non-bank lenders' strengths and areas where they may miss the mark. So let's go down here. So let's start out with embracing the Empire State of Mind. So nearly a century later, commercial real estate financing is once again in flux. Big banks are tightening lending standards while non-bank private lenders are increasing activity. In the first few weeks of 2025 alone, private lenders originated $4.43 billion in short-term commercial real estate loans, surpassing last year's first quarter total. With private credit near $2 trillion and more banks offloading commercial properties from their balance sheet, commercial real estate owners and operators are still struggling to secure financing for their projects. Many report frustrating negotiations with non-bank lenders, citing slow execution and inconsistent terms. For community financial institutions or banks, this ongoing post-pandemic shift in the commercial real estate lending market presents both challenges and opportunities. In this two-part series, we'll explore how CFIs can navigate the shifting CRE landscape and carve out a competitive advantage. In part 1, we'll examine the growing role of non-banks and how borrowers perceive them. In part 2, we'll explore strategies banks can use to compete more effectively. So the growing role of private non-bank lenders. So non-bank lenders have rapidly expanded their role in commercial real estate financing, capitalizing on the regulatory constraints and risk concerns keeping big banks out of the sector. Indeed, private credit's share of the U.S. lending ecosystem has grown by 1,000% since 2009, and McKinsey estimates another $5 to $6 trillion in commercial real estate loans could shift to non-banks over the next decade. So in here we have, I'm actually going to make this a little bit smaller here. I think I'm getting the whole thing in there. Yeah, okay, here we go. So I think this is good. So I think everybody can see this now. So infrastructure, asset-backed finance, and higher risk commercial real estate are among the asset types most likely to transition to non-banks. So assessment of factors affecting non-bank penetration of U.S. asset classes. So a couple of different colors here. So you kind of have like the navy blue is high, kind of a medium blue is medium, and then a kind of a light blue or baby blue represents low. So, and this is the propensity to transition to non-banks. So first you have a couple categories here. You have duration mismatch with banking deposits. Number 2, you have ease of origination for non-banks. Number 3, you have an impact to bank return on equity after the Basel III endgame, and then you have kind of a total. So so corporate and commercial finance, kind of standard loans, kind of in the middle. Structured loans are high. Structured loans have a high propensity here for moving over to non-bank lenders. Equipment leasing, kind of in the middle. Aircraft and rail car leasing has a high. That's high. Receivables financing, kind of low. Trade finance, kind of low. But then we get into, commercial real estate. So basically regulatory, less than an 80% loan to value ratio, kind of in the middle. And then we get construction loans and bridge financing, actually kind of low. Regulatory, I should say, greater than 80% LTV, has a high propensity to basically go out. And then non-regulatory also has a high propensity. Infrastructure, project finance has a high propensity to go over. And then on the consumer finance end, we have auto loans and leases kind of in the middle. Student loans are in the middle. Unsecured personal loans are low. Credit card receivables are kind of in the middle, and then residential mortgages are high. They're on the high side there, which is which is actually kind of interesting, because if you would think about it, like if they didn't really have any problems, why would they offload unless they perceive those residential real estate loans to be underwater, meaning that they've got they're locked in at 3.5–4% interest rates, and right now you could get a much higher rate. So maybe they feel like, some banks feel like, well, we can sell the portfolio and offload, and then we can and then what money we get back, we can then reinvest that into doing more new mortgages at higher rates with better yields. So that could be some of the thinking or some of the strategy behind that. But again, I think you're seeing some of the usual culprits here in this, like some of the things that are more on the higher side that would get banks in trouble a little bit. So like structured loans, aircraft and rail car leasing, probably have these things have higher levels of delinquency in certain periods. And then obviously real estate with greater than an 80% loan to value, and then non-regulatory. So so kind of, I would say, kind of the usual suspects, if you will, in a certain regard. Okay, but let's keep going here. So one of the biggest trends shaping commercial real estate finance today is the rise of floating rate short-term bridge lending. So Loan Core Capital, for example, recently originated a $1.15 billion commercial real estate collateralized loan obligation, or CLO, backed by 24 loans across multifamily, industrial, and hotel properties. From the perspective of non-bank borrowers, the most frequently cited advantages of working with non-bank lenders are more personalized service. It's kind of interesting. Easier access to loans and financing, and greater lender stability. It's another interesting one. According to the Altus Group, efficiency, execution, and more flexible underwriting also ranked highly, suggesting that while private lenders may not always offer the best pricing, they attract borrowers with customization, accessibility, and flexibility. Again, that's just, some of this stuff is kind of, more personalized service. I don't know about that. And then, are you telling me that the service is better than what you're getting at a lot of banks? And then greater lender stability. Well, if you're dealing with a bank that's been around for over, say over 100 years, how do you get more stable than that? I don't, versus a non-bank lender that's been around since, 2015. So I don't know. It's interesting. And then here's another one, figure 2. This is top benefits of working with non-bank lenders. Again, the highest ones at the top here, easier to secure. Let me see if I can blow this up here a little bit here. So easier to secure loans and financing, 29%, greater lender stability at 27%, greater timeliness or efficiency, 26%, greater certainty of execution, 19%, stronger lender credibility, reputation, 19%, more flexible underwriting criteria, 18%, able to provide more financing or larger loans, 18%. More loan flexibility, greater expertise with specialty property or asset types. That could be true. Closer or stronger business relationships, lower cost of capital. I don't know about that. More sophisticated underwriting process. I don't know about that. Better personal rapport, easier to work with, 15%. More standardized and consistent underwriting criteria. Okay, let me bring this back. Okay. However, the expanding role of private lenders for commercial projects comes with its own set of trade-offs. Private lenders often offer more flexible terms, but also charge higher interest rates than banks to manage their risk. And now, what did the survey just said here? It just said, where's the one I was looking for? Lower cost of capital. That was the 16% lower cost of capital. And I said, I don't know about that. And then it literally just says here, but also charge higher interest rates than banks. Like there you go. Borrower frustrations with non-bank lenders. So while non-bank lenders are known for faster closing times, requiring fewer steps for borrowers to secure financing, some borrowers report longer closing times and unpredictable terms. Many non-bank lenders also lack the relationship-driven approach that smaller banks excel at, creating opportunities for CFIs to differentiate themselves. See, and again, that's interesting, because if we go back up to the thing here, it says closer or stronger business relationships, 16%. Better personal rapport, 15%. that would indicate that, you're getting better customer service. Yet they just said here that, like, one of the problems is that you're not getting that relationship driven approach. In other words, despite their growing presence, private lenders often receive lower borrower satisfaction rankings than traditional banks. A recent survey found that non-bank borrowers rate their lenders at 7.5 out of 10 compared to 8.3 for bank borrowers. And then here's a figure with overall satisfaction. You can see bank borrowers are much higher, actually, than non-bank borrowers. Non-bank lenders, it's kind of interesting. Insurance companies, and then CMBS lenders and alternative lenders. Kind of a little bit about the same as basically non-bank. Basically, insurance companies and banks are getting higher scores than non-bank lenders, and then everybody else is kind of in the middle. So let's look here at some key complaints of non-bank customers. Include slow, inconsistent loan approvals, heavy reliance on third parties, and lack of transparency. So kind of interesting stuff here. So now let's shift over to, so this is part 2. So CRE lending part 2, strategies to compete with non-bank lenders. So with private lenders expanding their role, CFIs have an opportunity to stand out by leveraging relationship-based lending, faster decision-making, and targeted expertise. So how CFIs can compete and win. So to remain competitive in today's evolving CRE market, banks should leverage their strengths in service transparency and local expertise to differentiate themselves. Here are 4 key strategies to help. Number 1, assessing borrowers based on market performance. So not all commercial real estate sectors in metro areas are equally positioned for growth. Banks should closely track regional economic trends, vacancy rates, and rental growth by sector to identify which property types and markets offer the best risk-adjusted returns. Like, for example, multifamily housing is strong, or industrial properties continue to outperform, or retail and office markets are mixed. By aligning lending strategies with local market conditions, banks can avoid overexposure to struggling commercial real estate sectors and focus on financing high potential projects. So number 2, enhancing deal speed and transparency. Although it's true that beggars can't be choosers, at the same time, today's borrowers have grown increasingly comfortable with online applications and support. So simply put, to stand out from the crowd, the entire lending experience and process on a mobile device, in front of a monitor, and in person has to be clear, engaging, and efficient. Frequently, banks should simplify loan documents to reduce approval times, to create an easy-to-follow step-by-step loan application process borrowers complete independently. They can improve digital communications with borrowers at every step of the process. Notably, since most borrowers may never walk through a CFI's door, it's important to consider different types of digital outreach, like video calls rather than just phone calls, and leverage new technologies to speed up underwriting without sacrificing risk management. Efficiency will always be king, but providing faster, more transparent lending experiences, CFIs can stand out from non-bank lenders, which are often very impersonal and transactional, leading to consistently disappointing borrower experiences. Number 3, target niche lending opportunities. And number 4, know what non-bank borrowers want most. So many non-bank borrowers remain uncertain about the future of their financing, with 38% expecting lending challenges to remain consistent and another 38% anticipating greater difficulties ahead. Notably, more than half of non-bank borrowers are diversifying their lender relationship, 55%, and asset holdings, 54%, to reduce exposure to any single risk factor. And then it gets down in here, strategies for overcoming near-term risk and challenges. I'm not going to go into all of these different things here. And basically it just says, capitalizing on a changing lending market. So the commercial property lending market is evolving rapidly, but borrowers continue to value the consistency, reliability, and expertise that banks provide, qualities that many non-banks struggle to match. So again, I think some great things some great suggestions here in this article for how to deal with the non-bank lenders. But this is also become an issue of private credit. And I've done a couple episodes on private credit. You could definitely go back and check those out to get a little bit more information on that topic as a whole. I think the important things to recognize there are that sometimes it's good, like, in other words, banks have to have an outlet to be able to offload loans sometimes, and having those private lenders, private credit, if you will, having that market to be able to offload can really help a bank in terms of managing their capital, managing their resources, managing the loan portfolio, get some riskier stuff off the books. But it can also lead to a lot of other issues, because what if those private, lenders aren't doing what they're supposed to be doing? And what if they create, what if a lot of the loans go bad, and now we've got problems where some of these private lenders are potentially going to go out of business? Are they going to come looking for a bailout? That's the big, that's one of the big questions. And the other thing I would tell people is that there's a whole nother discussion here to get into, but I don't have the time in this video. But go watch my Lords of Easy Money series. If you go watch it, there's a very particular reason why private credit started to really blossom, if you will, starting in 2009 in particular. That's a very important date. So if you go check out the Lords of Easy Money series, you will get all those answers. But hopefully this provided a very interesting topic today, how non-bank lenders are really becoming a competitor for banks in the commercial real estate space, and how banks can continue to compete effectively against them in certain regards. So, but I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, remember to check out some of the other episodes and content on the channel, and I will see everyone again real soon. Thanks a lot.